Blu-ray, Pluto manufactures, produces high-definition television screens. The entity has a 31 December year end. Always very important. Good. They are not registered for VAT. The company uses the first-in, first-out method of inventory valuation. Very important. For the year ended 31 December 2015, the applicable manufacturing balances as per the general ledger were as follows. So in the beginning of the year, there was no work in process. The end of the year, there's no work in process. In the beginning of the year, our finished goods was 400 units worth of 180,000 in the finished goods account, and then our allowance for unrealized profit was 30,000 rand. Because nowhere in the question further on they tell you what is the unrealized profit percentage which the factory or the production environment add to the cost of goods manufactured when they transfer those goods to the sales department. But I can work it out. What is the actual value of or the actual cost price of this inventory items as at the beginning of the year? That is the 180,000 divided by minus 30,000. So that gives us 150,000. What? Why? Because I take out the unrealized profit when I actually disclose my value of inventory in the statement of financial position, because I have to show that cost price. So if my actual cost price was 150,000 and I add 30,000 rand I had as unrealized profit, then it means I can work out what is the unrealized profit percentage, and that equals 20%. Right, so where does the 30,000 comes from? That is what they gave us. I said the allowance was 30,000, the actual cost price was 150,000. Therefore, our markup percentage is 20% from the factory environment to the sales department. Then they also give us the following information. They say that the manufacturing cost per unit during the year ended 31 December 2015, that is the current year, was 500 Rand per unit. And that entails the material, the labor, and the overheads, in total 500 Rand. This is the actual costs. So this is the cost that was accumulated in the work in process account. Now, they say during the year 31 December 2015, 7,000 units were manufactured. So if that was the actual cost of manufacturing, we can now work out the total cost of manufacturing. While 6,290 of these units were sold. So what was the actual cost? Let's just work it out. That is the cost 500 Rand. That would have been in the work in process account. At what amount would we have transferred that amount, those items to the sales department? Would have been with a 500 multiplied by 20%. And that actually gives us 100. So we would have transferred those inventory items at a cost of 600 Rand to the sales department. Now, they tell us 7,000 units were manufactured, of which 6,290 of them was sold. So the actual cost of sales, or the cost of sales in the finished goods, would have been 6,290 of 6 multiplied by 600. All these units were finished at 1 January, that were finished at 1 January 2015, were also sold in the current financial year. How many units was that? That was 400 units. So that means what was our total sales then? Our total sales then would have been these 400 units, of which we have the cost, 180,000, plus 6,290 units at a cost of 600. That was our cost of sales in our finished goods account. BRPM does not keep any incomplete goods on the premises, so work in process doesn't have an opening and a closing balance. Then the normal markup added by the sales department, please do not get confused, is 66 and 6% on cost. Now, it is important that you realize that the sales department already receives these goods from the production area at an inflated cost. So when they determine the selling price of an item, that would equal then the selling price that will equal the inflated cost per item multiplied by 1.66666666, 66.67% on cost. So that would have been. So this is not to do with the internal transfer from the production area to the sales department. This has got to do, number 3, with what are we going to charge our clients for this item that we're going to sell. Then the sales department incurred the following costs: admin expenses and selling costs. Now that is a normal operating expense. Now the question wants you to show the general ledger accounts for the year ended, number 1 for finished goods and number 2 for the allowance for unrealized profit. And then number 2, show the statement of profit or loss up to the final gross profit figure. So that's only going to be sales less cost of sales. Good, so let's go and have a look. We said that it costed us 500 Rand in order to produce one single item in the factory environment. Then we've said, well, we've worked out our unrealized profit and we've said that that is 20%. So that means we've added that 20% to the 500 to determine the price at which the sales department will receive the goods at. And that is 20% of 500 is 100. So the sales department is going to receive the goods at 600 Rand per unit. Now, how many units, here's just how I worked out the 20%. How many units did we have in the beginning of the year? We had 400 units at the beginning of the year, and the total cost of that 400 units was 180,000 Rand. Then we manufactured 7,000 units, and the total cost of that 7,000 units that the sales department is going to receive is 600 Rand per unit. So in total, 4.2 million Rand. How many units were available to sell? 7,400. What was the total cost of that? 4,380. Now, how many units was sold? That first 400 units was sold, which is 180,000. We have the cost of that. And then we have sold 6,290 units of this batch that we manufactured in the current year at a cost of 600 Rand per item. So 6,290 multiplied by the 600 Rand, the value, the cost of those items would have given us 3,774. So at the end of the day, what is going to be our closing inventory? Well, we had 7,400 available to sell. We've sold in total 6,690 units. So we have left at the end of the day 710 units. At what price? At 600 Rand. That's 600 Rand per item. So our closing inventory, 426,000 Rand. Now let's do all these calculations now in the accounts. Let's start with our finished goods account. They gave us the opening balance, 180,000, and they gave us the opening balance for unrealized profit, 30,000. Unrealized profit, and this is our statement of financial position account, 30,000. Then they've said that we have manufactured during the year 7,000 units, multiplied now by 600 Rand. So out of our work in process account, we have transferred then 7,000 items at the actual cost price of 500 Rand, 3.5 million, and then for the unrealized profit, 7,000 units at 100 Rand, and that gives us 700,000. And the counter leg of that 700,000 is our unrealized profit P&L account, 700,000. Then we said, okay, what was our cost of sales for the year? Now, our cost of sales for the year was that 180,000, and 6290, the number of items of the 7,000 that we've sold during the year at a price of 600 Rand, 3774. Remember, in our finished goods account, we have to work with the inflated figures with the 600 Rand and not the 500 Rand. So that then gives us a total of 3,954,000. Closing balance, we've already worked that out as well. We had 710 items at a cost of 600 Rand an item, and that gives us 426,000 Rand. 426,000 Rand, and then this thing balances off quite nicely. Now, what is our unrealized profit component included in our closing inventory? Well, we know that our unrealized profit component is 100 Rand, and we had 710 items on hand at year end. So 710 multiplied by 100 Rand will give us our closing balance of our allowance for unrealized profit, which equals 71,000. Or if you wanted 426,000 times 20 divided by 120, gives me the same 71,000, and that is what our closing allowance balance is going to be. To move from a 30,000 to 71,000, I'm going to need on the credit side of my allowance account a 41,000. So that's the credit entry, and the debit entry is against our unrealized profit P&L account, 41,000. Right, and then in our unrealized P&L account, we are going to post the balancing figure of our unrealized profit and loss account, 659,000, to our cost of sales. So what is going to be total cost of sales? It's going to be 3,954 less 659,000. Now, we have to determine the selling price of these goods as well. And we've said that that would be the inflated cost per item multiplied by 1.6667. So sales would have been our total cost of sales, 3,954,000, multiplied by 166.67%, which gives us 6,590,6,590. Now, the cost of sales you can record in either one of these two ways. Both of them is correct. I do prefer the second method because that's cleaner. Cost of sales, I could have taken the cost of sales here, the 3,954, and then I could have adjusted it with the difference with the 659,000, which was lying actually in our cost of sales account, our unrealized P&L cost of sales account. Good. So there's a 659. I could have derived at the 659 on various ways and calculations. I could have said, well, 3,954,000, included in that figure is 20% unrealized profit. So multiplied by 20 divided by 120, that gives us 659,000. I could also have said, well, that included in our unrealized profit figure for the year, 700,000, 41,000 of that 700,000 is still outstanding. It hasn't been realized as yet because that 700,000, or this 41,000 pertains to all the unrealized P&L during the year that was actually realized. So 700,000, the total unrealized, less 41,000 gives us 659,000. If I then add back the manufacturing profit, I call it manufacturing profit, you will see that in a number of the memos. Then I'm going to add back the cost of sales unrealized profits of 659 to our preliminary gross profit figure of 2636, and that will give us net gross profit of 3295. Now, what I would really suggest that you do is this one here. Where did I get that 3295? That 3295 was purely the 3954 less the 659, and that gave me the 3295. And that leaves us then with a gross profit at the end of the day. Oops, there's English. There's the English, a gross profit of 3,295,000. So there are many ways to skin this cat. I would really recommend that you're going that route there because that is the cleanest route. It makes the most sense. Here I had my cost of sales of 39454. There's the adjustment against my cost of sales of 659. So the difference between those two will give me my total cost of sales of 3295.